Hi everyone, hope you're all doing well today. I'm going to talk about the three stocks that I'm buying in May 2020. I'm going to go through these three stocks and tell you why I'm buying these three stocks currently. These three stocks I bought were not last week, the week before. Sorry, I'm just a little bit slow to update you guys again. It's just been one of those crazy weeks in the stock market with earnings and the stock market going down, and I was talking about them opportunities, but I thought, you know what, I need to update you guys just to keep that transparency up, that you know what I'm buying and selling. So yeah, we'll go through these three stocks. I think these three stocks are fantastic opportunities, three stocks that are really beaten down, and I think a lot of these three stocks in particular have really good upside, and I will carry on buying these stocks as much as I can in the month of May. So we'll take a look. Now, if you do want to know what I'm buying and selling in real time, make sure you join the Patreon. That's where I'm posting in real time what I'm buying and selling. As well as that, I do upload 2 exclusive videos a week on there. The last one being this one, which is a series that we have, which is called Stock Request, where the 600 members of the Discord, which you can talk to as well, put forward a stock they would like me to take a 5-10 minute look at and give my opinion on it. And the 3 that get the most likes, we review them and talk about them. This week, the 3 were Shopify, Legal & General, and Garmin. So if you do want to be part of that, the link is in the description. But we'll take a look at these 3 stocks that I've been buying recently. And number 1 is InMode, one of my favorite companies in the stock market, one of the positions that is already in my top 5 biggest positions, and I want to keep adding into that. There's not really too much risk that I see with InMode at this sort of valuation. Really, there's only 2 risks, which I'll say straight up, is that, first of all, the numbers are that good that I am questioning whether or not the numbers are legit. That is how good this company is, especially at the valuation it's at. And there has been a bit of insider selling, but that was actually before the share price fell off a cliff. So the insider selling was during this kind of period here, not where the share price has dropped off massively. That would be more of a worrying sign if the shareholders were dumping off. At this point of view, it was at this point where they were dumping off shares, which you can kind of understand when you've been on this such a good run, and as well as that, they IPO'd around this point of view, so their lockup period would have ended as well, so it kind of all ties in together. So the 2 risks that I do see aren't major ones, but I thought I'd make that very clear about what I'm seeing right now, because apart from that, it's an absolutely unbelievable good opportunity here. It's currently trading at $25. It's a $2 billion market cap, which is pretty small, but in the long term, I do generally think this will be potentially a $10 billion plus market cap in the next 5 years, which is a massive amount of upside. And since the IPO, it did okay, and then it got caught up in the CV dip, lost a lot of its value. I looked at this one. It was actually Ben who recommended it to me and said, have a look at this one. I was like, wow, this is unbelievably good. Started buying around May time. The stock went on an unbelievable run, and then it's been caught up in the sell-off, the stock market crash that we've been having at the moment, and this stock is currently down 73% at the moment. And looking at that 73% drop off, I can't believe how much it sold off. For me, this drop is just massively unjustified. The company is unbelievably firing on all cylinders, putting some fantastic financials. And it's not like, a lot of these companies in this big, massive stock market crash that we've been having at the moment, you do look at a few of the companies and go, yeah, it was a bit of a high valuation. With InMode, you were looking at it going, it's not actually too bad. And now that it's fallen off that much, over 70%, the company is now trading down at 13 times earnings. I cannot believe how cheap this company is at 13 times earnings. This is unbelievable. When we look at the growth and you compare this to the growth and the balance sheet and the amount of profit they're producing, you start comparing that to a Procter & Gamble or a Coca-Cola or someone in that top line, a company that's growing at 2-3% a year, and they're trading up at like 30 times earnings, and this is down at 13. It's crazy. Now, if you don't know what InMode does, they basically produce a lot of technology medical products. So they try and improve your appearance, and I'll just put some like before and after photos here of some of the different technology devices they do have. They have got quite a lot and are very diversified about the amount of technology they do have. And basically a lot of this is to help your appearance. So as long as you think the kind of appearance and more conscious about how people look will carry on improving, then this company will probably do well. Basically as well, the technology avoids more of the traditional ways that you would get yourself to potentially look better. So a lot of this would be more like going under the knife surgery, and you'd have to have an operation. This is basically a lot of procedures where you go in, you have this procedure done, and that's it, you're done, and you go home again. You don't have to be under the knife or put to sleep for certain of these procedures. It's all technology based, which is massively different, and probably be more people would be more open to having these sort of procedures done with InMode and the technology they have. So If you think people are always going to be more conscious about looking better or having treatments to look themselves better and would prefer to do this through InMode and their technology rather than being under the knife, then this company obviously has a very good future, which obviously I massively believe in at the moment. And the crazy thing with InMode is the financials they've been delivering in the last few quarters have just been unbelievably good. You know, they came out recently on April 11th and reported their Q1 preliminary results, and they were unbelievably good. You know, the Q1 revenue came in the range of 85 to 85.5 million, and it was supposed to be 80 million. Really good beat. On the non-GAAP earnings, it was a 0.38 to 0.39, and that was versus the consensus of 0.36. So the revenue is always way ahead of what is expected. The earnings is way ahead of what is expected. And on the day, what was the share price rewarded with? It was rewarded with a 7% drop, and it was like, come on, you know, this is unbelievably cheap. You're putting a 7% drop on a company that just reported earnings that have absolutely smashed it. It was just crazy. So even though I'm currently still up on this position by, I think, something like 50%, I am massively averaging up on this one at the moment. And if you look at the company and the financials they delivered, if you look at the amount of profit and revenue they're increasing by, it's unbelievably good. And going forward, this company should grow at quite a good rate still. We're expecting hopefully around 20% revenue growth. And this year the profit is actually going to probably be a little bit flatter than normal. That's because they're having to start paying taxes a lot more this year. So you'll see this kind of flat line this year. And then going forward, we should see that revenue once again increase massively back in the right direction. The profit, increase massively back in the right direction. So we're going to have a company that puts in really good amounts of revenue growth, really good amounts of profit growth, you know, really heavy amounts of cash being produced here. And that's led to a balance sheet that's unbelievably good. You know, there's no debt on there. They're sitting on 415 million in cash. And what they do with that cash, I mean, they could potentially go down the route of a dividend. They could buy back a lot of shares, which they have started to do as well. So, you know, it's fantastic. It's absolutely fantastic. And like I said, you know, it's down at 30 times earnings. It's just, you know, for a company that's producing this amounts of cash, the balance sheet that they have, the revenue growth, the profit growth, at 30 times earnings, it's just silly. And you know, you look at the valuation point of view and look how low it's actually, you know, priced at right now. It's just scary. So from my point of view, you know, you're already talking about a stock that is should be double the share price right now already from an undervalued point of view, and then you start ramping up as well. And I think even if you double it up, it's still very cheap. But you know, I think it should easily be double the share price of what it is right now. And then you start working out, okay, you run 20% revenue growth numbers on it, gross profit at 10-20%. It's just insanely good. And this is why I think you're left with a, you know, potential 5x opportunity in the next 5 years on this stock. It is fantastic. So I did pick a few more shares up in InMode. Number 2 is Gang. So once again, I've been buying some more shares in Gang. I am trying to average down on this one massively. At these sort of valuations, it is just such a good value. When I started buying Gang originally, I was like, okay, I think this stock can potentially 2x in the next 5 years. I now look at Gang and thinking at these sort of prices, this stock has major upside. We're talking now 5 to 10x potential in the next 5 years, which is just insanely good. It's down at 157 million market cap, which is absolutely crazy when I show you a few details in a few minutes. Now, this stock actually came onto the stock market around $14. It actually peaked around February time around $30, and since then it's lost 87% of its value. Now, if you don't know what Gang does, they basically have two products. One of them is their B2B, and this allows a lot of the US has for a long time not allowed online sports betting, gambling. It's now starting to allow it. So a lot of these kind of legacy casinos and platforms are trying to get online, and to have that to come online can be quite difficult to create that product. So very much like a Shopify, if you had a normal classic store and you wanted to go online, you might use Shopify to set up your online presence through Shopify. Gang's exactly the same. You know, a lot of these casinos want to get online. Use Gang, and Gang will get you online, and they obviously take a little bit of commission for doing that. So that's the first part of the platform. The other part is they actually have a betting platform which they acquired, which was Coolbet, and that's their B2C platform. So they have two separate incomes here in a very big, massive growing TAM at the moment, which is fantastic. Now, the company is currently valued at 157 million. One of the parts of the platform that they have, which is Coolbet, the B2C platform, is on fire. It has had a fantastic 2021, growing at insane rates, and the company is now valued at less than what they bought Coolbet for in 5th of January 2021, and they paid 175 million for it. This is the first part about how unbelievable this valuation is right now. And the thing is, you know, Gang paid actually of quite a decent value. Like, it was a pretty cheap valuation they paid for Coolbet as well, which is just bonkers. And that's just for the Coolbet platform, not even the B2B platform. And also Coolbet's grown massively as well in the last 12 months, which is just insane. And from an IPO point of view, when they came onto the stock market, when they came onto the stock market, they were valued at 209 billion. And at that time, they were doing 29 million in revenue. Now they're doing over 135 million in revenue. The revenue has 5x, and the value of the company now is less, 25% less of when it came to the stock market. It is unbelievably cheap right now. And in the recent investor presentation, Gang said that they are going to aim for 2023 revenue expected to be 225 million to 250 million. And that would be a 3-year CAGR of 35% at the midpoint, and also to have 30 to 35% adjusted EBITDA margins at scale, which is very good. So you start running, a good amounts of, maybe 10%, 20% profit on the bottom line. You start running 225, 250 million. If they could get to their revenue targets, even if they don't get to that point of view, like even if we said like 200 million, it's unbelievably cheap at these sort of valuations. Are you going to be talking about Gang that trades down at times earnings of 4 or 5, which is just bonkers? You're not going to get a company trading down at 4 or 5 times earnings that's got 20-30% revenue growth, good profit margins. It's not going to happen. It's unbelievably cheap at the moment, and it's scary how cheap it is. And this company just put in a fantastic 2021. You'll be able to see here that they grew their B2B platform from 335 million to 46 million, so some really good growth there. And obviously the B2C platform as well has been absolutely fantastic, a great acquisition. That's just put in 7 to 8 million of revenue, and like I said, when you look at what they paid for the company as well, 175 million, unbelievable. And then you look at the gross margins of this product, 75% gross margins on B2B, 62% on B2C as well. So what's going to happen a lot in the next few months now in this 2022 period is we're going to see these net losses start shrinking down as well, which is going to be really good. So it's going to be very interesting to watch this year. And then when you look from a metric point of view as well, it's really cheap as well from a metric point of view as well at the moment compared to what it used to be at. So yeah, in my opinion, this is fantastic opportunity right now. I am really jealous of anyone that can start a position down at these sort of prices. I am so jealous right now, but I am trying to average down my position here, because if I can get my average position lower and lower right now, like I said, for me, this is one of the stocks I own that in the next few years offers a unbelievably good upside opportunity right now. So I am picking more shares of this one. And the last one is Shopify. So this stock is, once again, this is another stock that's been hurt massively. At the peak it was, well, on the 52-week high it was 1,700, but on here on Google it says 1,690. The stock is currently down 74%, and it's the same share price as basically as what it was pre-CV. So anything pre-CV has totally been wiped out. One thing to not make the mistake of, it does say 20 times earnings or 18 times earnings. That's not true. That's a one-time payment, so please don't fall for that. We're now down at a 53 billion market cap. I think this has a lot of upside here. And if you don't know what Shopify does, it basically makes a lot of sellers able to get onto e-commerce and sell their stuff online. Whether you're an individual seller, a small business, a large business, it caters for you all. And Shopify, I think, has a really good platform. It has quite a bit of a good moat, because I feel like for anyone to get to the size that Shopify has to be a competitor, it's very hard to scale up. And also, I think when you're in the Shopify platform, it would be very hard for you to move your website away from them and recreate that somewhere else. And Shopify now offers so many different services. It's not just about, creating a shop online and then managing it for you. They manage the payment side of it, they manage the capital side of it. You can get capital from them, the marketing side of it, the analytics side of it, the inventory and fulfillment, which is one of the bits why at the moment they don't currently actually make profit. Well, they did last year, but they probably won't this year, is because they are ramping that up a absolute huge amount. But the rewards of reinvesting into the company will mean that they will, when they mature a lot more, they'll have a lot more going to the profit, and they'll also create a lot more revenue that will then turn into profit, which is great. So this is a new thing they're building out: inventory and fulfillment, order management, shipping, send all the products out for you. Really good. Companies that use this service, I think, like I said, it's a very sticky platform. And like I said, pre-CV, they were losing money. They did 1.5 billion in revenue. Now they're doing 4.6 billion in revenue, and they're doing profit. Obviously, the one-time payment did help, but they are doing profit, and the revenue is still going to increase at a massive rate going forward. So I think you got a company here that's still going to massively increase these revenues going forward. And the thing is that if they wanted to, they could be profitable. And I think this company will put mass amounts of profit in further down the line. You know, the gross profit they make on the actual service they offer is great. You can see here that they make, you know, 4.6 billion this year in revenue. They're going to make 2.4 billion in gross profit. They're only spending a lot on sales and marketing. You know, you cut that down, they make it, you know, nearly 500 million more in profit. Research and development, you know, growing the services they offer the business, which will then create more revenue for them. If they didn't want to kind of carry on growing and gain more of that market share, then, you know, sure, they can cut this down and they would make 400 million more profit. Same with general and admin. Shopify, in my opinion, is the e-commerce platform that everyone's going to go to. Small, large businesses, medium-sized businesses, they're all going to be using Shopify platform. It's such a great service with all the tools that it has. And like I said, I think it's a very sticky platform with a very good moat, and it carries on reinvesting into the company, and it's going to grow at very good rates. At 53 billion market cap, you know, maybe it doesn't make money, but if it wanted to, if it didn't want to grow as quick, if it didn't want to make more money from the sellers that use the platform, that's fine, but it's not going to be the scale of what it potentially could be, and it's capitalizing on that. And when it does mature, when it does want to, you know, focus more on profit, this company, in my opinion, is going to put really good amounts of, you know, 3 billion, 5 billion, 10 billion in profit. And then when you work out, you know, 3, 4, 5 years down the line, that mass amount of profit that starts coming in, this is a very attractive valuation, in my opinion, for Shopify. So I hope you enjoyed the video, guys. These are the 3 stocks I'm buying in May 2020. Let me know what stocks you've been buying in the comment section, and as well, let me know what you think of these 3 stocks, and I'll see you on the next video.